we've looked under the hood. We see that the economy really isn't as strong as the statistics would tell us. We think that we know that the Fed is going to have to cut rates because the economy's slowing. We think inflation is not as weak as the government is saying. We've been saying, why doesn't gold move? But for the normal investor, all of the macro environment was not conducive to gold. That's now clearly beginning to change. First of all, we've had the rate cut. Gold always moves since 1980. Gold has always moved on the beginning of a rate cut cycle. I think it's difficult for some people might still think we're going to have a soft landing, but you don't hear people talking about no landing anymore. I mean, it's clear that the economy is weakening or less strong than it was.
Commodity analysts who make long-term forecasts believe that the price of gold will generally keep rising in the next few decades as the demand for the precious metal increases. In recent years, gold prices have soared, reaching a record $2,600 per ounce in September 2024. However, when adjusted for inflation, the peak for gold remains in the early 1980s. In a surprising move, AdrianDay predicts that a Fed rate cut is inevitable, noting that gold has historically surged after rate cuts since 1980 and may have already priced in this expectation. Between March and August 2024, gold broke its all-time record price in nominal terms every month, breaking the $2,500 threshold in August. When adjusted for inflation, the gold price is close to the 1980 peak, caused by the oil crisis inflationary shock, and the 2011 peak caused by the sovereign debt crisis in the euro area. It has already passed the peak caused by the 2020 pandemic-related shock. Observing the market dynamics, Adrian emphasizes that recent gold price surges are driven by central banks and Chinese investors rather than macroeconomic factors. However, Western investors have dismissed it due to conditions like a strong dollar and high interest rates. According to Goldman Sachs, the volume of global central bank purchases of gold has tripled since Russia invaded Ukraine in early 2022, which also named concerns over climbing U.S. federal debt and the potential for increased institutional capital into gold exchange-traded funds as a driver of higher gold prices. As per AdrianDay, the Federal Reserve's impending rate cut amid a weakening economy will elevate pressure on gold. He notes rising credit card debt and job revisions as signs of struggle, particularly for lower-income Americans. Now, we present the clips of AdrianDay's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Part of me was thinking over the last several weeks, look, a rate cut is baked into the cake. Everybody knows it's coming, right? Are we going to have the buy the rumor, sell the news event? And would gold actually not go up after the Fed cut? Sorry, let me back up. As you know, as I think your listeners probably all know, but as you know, every time they have embarked on a rate cutting cycle since 1980. So after the 1980, after Paul Volcker took T-bill rates or Fed funds rate up to nearly 20% and killed inflation. But after that particular rate cutting cycle, gold has always shot up immediately afterwards. So that's the background. Then I'm thinking, well, gold has already discounted this rate cut, surely. And then my third thought was, you know what? The reason gold has been going up for the last 2 years and for virtually all of this year, as we've talked about before, and as everyone knows, is nothing to do with the macroeconomic environment. It's to do with central banks buying gold because of dollar weaponization. It's because of Chinese savers, Chinese investors buying gold as a safe haven from their own domestic concerns about the economy and the banking system. So in fact, even though the gold price moved up dramatically, one could argue that perhaps it wasn't actually discounting the interest rate cut. It was completely different other factors that were forcing it to go up. The Western investor, Western Europe and North America, they look at the macroeconomic environment, and the macroeconomic environment, until recently, has actually not been favorable for gold. We must emphasize that. When people talk about, well, it's illogical that the gold stocks aren't going up, but gold is, and why is this, and blah, blah, blah. I mean, sorry, and so on. it's not so illogical if you look at who was buying gold and why they were buying. Then look at the macroeconomic environment. Until recently, a strong dollar, not now, but high interest rates, high real interest rates, low and declining inflation, apparently, according to the government statistics, and according to the government statistics, a strong economy and a strong stock market, which meant you didn't want to be buying gold stocks. So until the last sort of month or 6 weeks, there was really no particular incentive for a Western investor to say, I want to buy gold and gold stocks. The only incentive was that the darn thing was going up. Now, I think you and I and other people in the gold community, we are so focused on this. We've looked under the hood. We see that the economy really isn't as strong as the statistics would tell us. We think that we know that the Fed is going to have to cut rates because the economy is slowing. We think inflation is not as weak as the government is saying. And so, we've been saying, why doesn't gold move? But for the normal investor, all of the macro environment was not conducive to gold. That's now clearly beginning to change. First of all, we've had the rate cut. Gold always moves since 1980. Gold has always moved, or since after 1980, I should say. Gold has always moved on the beginning of a rate cut cycle. I think it's difficult for some people might still think we're going to have a soft landing, but you don't hear people talking about no landing anymore. I mean, it's clear that the economy is weakening or less strong than it was. I mean, in my view, it's weakening significantly, but no one can deny now when you look at those jobs revisions, when you look at credit card balances, credit card defaults, it's clear that particularly at the bottom half in terms of, that's not a moral statement, bottom half in terms of income and assets, the bottom half of the US is struggling. And so it's clear that the economy is...
Regarding recent market trends, AdrianDay observes that gold typically sees a significant rise in gold stocks following a bottom. He highlights that 2001 gold rose about 12% in the first 3 months following its bottom, while gold stocks soared over 50%. He points out that gold stocks have not matched gold performance, presenting a rare and attractive opportunity for investors. As the performance of gold mining stocks continues to improve, there's growing potential for increased interest from generalist investors. These investors, who may not typically focus on the resource sector, often look for two key factors when considering an investment: profitability and growth. Typically, August is considered a seasonally strong period for gold, while September tends to be weaker. However, the fact that gold stocks have performed well heading into a traditionally weak season could be seen as a positive sign of underlying strength in the sector. Despite rising gold prices, Adrian notes that senior gold companies remain undervalued. He emphasizes that Agnico Eagle is nearing a 40-year low, suggesting that this mispricing will be revealed as earnings are reported. Let's get back to the interview.
Typically, when gold bottoms and moves, the gold stocks will typically have a very dramatic outperformance in the first 2, 3, 4, 5, 6 months. And just an example, in 2001, you saw that gold, I think, in the first 3 months after the bottom was up like 12%, the gold stocks were up over 50%. This is a very, very unusual and very, very attractive opportunity for investors. As you say, we've had gold at new all-time highs. Gold, I'm sorry, everybody knows how much has gone up in the last 2 years. We've seen dramatic performance from gold in the last couple of years. Gold and the gold stocks are more or less up the same amount over the last 12 months.
Yeah.
Very, very unusual. You would expect with gold having gone up, 36% in the last year and more if you go back 2 years, but 36% in the last year to new all-time highs, you would expect typically for the gold stocks to be up 50 to 100%.
Yeah.
So people have a very, very unusual and attractive opportunity right now. As I've said, the senior companies are still they're still undervalued. They're undervalued relative to their own historic price. They're undervalued relative to their own historic valuation, which is more important. And they're undervalued relative to the gold price. Now, if you just look at, let's see if I have it up. Oh, well, that's 1 year. But let's look at this year. And you can see that in the second quarter, the gold price was, and I don't have the exact number, maybe you do, but I'm just guessing looking at the graph. The gold price, average price in the second quarter was probably about $220 an ounce higher than the average price in the first quarter. So no surprise that after a first quarter with strong cash flow, the second quarter saw even stronger cash flow for most of them. Now look at the third quarter that hasn't quite finished, but almost finished. And again, I'm estimating that the average price in this quarter is going to be about $150, $160 an ounce higher than the second quarter. What that means is that we should get, in the third quarter when they report, we should get even stronger cash flows from the producing companies. Now look at the valuations. You look at Agnico Eagle at the end of the second quarter after the, two back-to-back quarters of strong cash flows, trading at about, and I don't have it pulled up, but trading at about 8 times cash flow. Look back over their 40-year history. They've been lower than that for one quarter in 2016, for one quarter in 2015. I mean, we are very, very close to a 40-year low in terms of price to cash flow for Agnico. And Agnico is a good company to look at because, there's no hairs on that. There's nothing wrong with that company. You can't look at, people look at Barrick and say, oh, well, that's cheap because they're in Pakistan.
Right.
That's cheap because they just did the merger, Newmont. Oh, well, that's cheap because they had a lousy balance sheet. You can't say any of those things about Agnico. And yet the valuation is close to its low. And so when we have the third quarter with $150, $160 an ounce higher gold price and the oil price lower, that's the other thing. Look, and the oil price, as you know, is the number one cost input for miners. So the cost should be lower. Certainly the revenue line will be higher. And so unless Agnico moves significantly higher, it's going to be trading at a 40-year low in terms of price to cash flow, which simply doesn't make sense.
Sky-high gold prices have been driven by central banks and investors increasing their asset allocations to precious metals. As reports reflect the increasing profitability of gold companies, a reevaluation may lead to substantial gains in their stock prices. How do you anticipate the evolving economic landscape will impact your investment strategy in gold and related stocks? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.